That individual is not breathing because they don't understand that if I have a $10,000 monthly payment to debt, then my company, after taxes, has to make a minimum of $120,000 this year. And when you ask them what their profit was they're going to make, and they say $60,000, we have an issue right away. So in other words, our clients, now why don't they understand it? Well, most of them don't understand accounting, right? Everybody, you guys have experienced this, they don't understand accounting. So they look at their profit and loss statement, and if they see a value there that says $60,000, because they're sitting there writing checks out of their checkbook, and they wrote one to the electrical bill and the suppliers and the labor and whatever that payment to debt was, credit card, loans, lines of credit, whatever it happens to be. So they think the reconciliation of what they're looking at on their profit and loss statement tells us that I'm this far ahead after all those checks have been reconciled. We know that's not true. If that client makes $60,000 and they're required to make $120,000, they've just hurt their company, and they've hurt it bad. Because specifically what happens is there's an erosion of working capital. That's what happens. In other words, if I had, I use this analogy all the time, if I had a mortgage payment of $10,000 a month, if everybody had a mortgage payment in this room of $10,000 a month, you would know that you and your spouse, after you paid taxes, would have to have $10,000 to keep a roof over your head every month. That's what would happen. Simple math, right? We all know that that's how we pay our mortgages. If I go through, let's say, 4 months of making those payments and I get to the 5th month and I'm a little short, and I go, hey, Jim, I'm a little short, can you lend me some money? Well, how much are you short? I'm short $3,000. Okay, well, what have I done in this particular case? I've borrowed $3,000. Jim, how do you want me to pay you back? I would like you to pay me back by giving me $1,000 a month. How much do I have to make the next month? $11,000, right? So our clients, on a regular basis, come up short as it relates to working capital, and that working capital itself needs to be made up by what? Another analogy to give you an example of this, and this is working capital, and whatever your definition of working capital, I want you to see it from my side for 1 second. We go into these clients, and when we look at the point, did they get a sale, through the point that they actually get paid, not when they invoice the client and then count the days in terms of accounts receivable, there is a funding over that entire period of time. It can be calculated under what does the client have in working capital. An analogy I use is if we all decided to drive to Dallas right now, we could figure out how much we need in our pockets in terms of gas money, because we know the miles to drive to Dallas. We would know what the average miles per gallon the vehicle got, the size of the tank, and then last but not least, we would know what the average fuel price is. And it would tell us that we need roughly $800 to drive to Dallas. When we check our pockets and we see we only have $400, would we make that trip? No, it doesn't make sense. It's not safe, right? We would know that we'd probably end up only halfway, so that's an issue. So that is working capital required calculation is the $800. The working capital we have, the $400, is working capital actual. If that is a deficit, our clients are making decisions constantly without awareness. Because what are they doing? They don't understand what their working capital required is. They don't understand what their working capital actual is.